90% of professional fund managers don't beat the S&P 500. That's not a claim, that's the data. For over 2 decades, researchers have tracked the performance of active mutual funds against simple index funds. The results are consistent, boring actually. 90% of the people paid millions of dollars to pick stocks can't outperform a robot that just buys all 500 companies in the S&P 500 in proportion. So why are people still paying for active management? The financial industry has a marketing problem. It's very hard to sell something boring. It's easy to sell the idea of beating the market. The promise of a manager who can find the next Apple before anyone else, who has special insight, who can time the market, who can generate alpha. That sells. What doesn't sell is a spreadsheet showing that a low-cost index fund tracking the entire market has outperformed 90% of active managers over the past 20 years. This is about money though, not philosophy. If you're trying to build long-term wealth, this decision affects every dollar you invest. It compounds. It matters more than almost any other decision you'll make. In this video, we're going to walk through the data on active versus passive investing. We're going to show you Warren Buffett's $1 million bet that proved this in real time. We're going to explain why 90% of managers underperform. We're going to break down the fee comparison. And at the end, we're going to give you the framework that anyone can use to outperform 90% of investors without picking a single stock. The Standard & Poor's Index versus Active (SPIVA) reports are published semi-annually. They track the performance of active mutual funds against their benchmarks. The data covers 10, 15, and 20-year periods, which is the only time frame that matters for serious investing. Here are the numbers. From 2000 to 2020, 89.1% of large-cap active funds underperformed the S&P 500. For mid-cap funds, it's 84.3%. For small-cap, it's 88.5%. For international developed markets, it's 93.2%. For emerging markets, it's 93.9%. For bonds, 88.6% of active bond funds underperformed their benchmark. These aren't small numbers. These aren't close calls. This is not 60-40 or 70-30. This is 89% of professional managers failing to beat their benchmark. The SPIVA data also tracks survivorship bias. Many mutual funds close down when they underperform. They disappear from the records. When you account for funds that close due to poor performance, the underperformance number gets worse, not better. The actual percentage of active funds that beat their benchmark, accounting for those that closed, is lower than what the published data shows. Why does this happen? First, there's the fee drag. An average active mutual fund charges 0.5 to 1% per year in fees. The S&P 500 index fund charges 0.03%. That 0.97% annual difference is a headwind that the manager has to overcome just to match the index. Over 30 years, that 0.97% difference turns into a difference of millions of dollars. Second, there's trading cost. An active manager buys and sells stocks constantly. Every transaction has a cost. The bid-ask spread, the commission, the market impact of their large trades. A 0.5% annual trading cost is reasonable for an active fund. That's another headwind that has to be overcome. Third, there's the efficient market hypothesis. The market prices in all available information. There are thousands of smart people analyzing stocks. The price of a stock reflects the collective analysis of all of them. So when an active manager looks at a stock that costs $50, that price already reflects all the analysis. The manager thinks it's going to 60, but the market already thinks that. The manager thinks it's going to 40, but the market already thinks that. The manager's insight has to be better than all the collective insights already priced in. That's a very high bar. In 2008, Warren Buffett made a bet with a hedge fund manager named Ted Seides. Buffett offered $1 million that an S&P 500 index fund would outperform a selection of hedge funds picked by a top manager over a 10-year period. Sides accepted the bet. He selected 5 hedge funds that he believed would beat the market. These weren't random hedge funds. These were top performers with strong reputations. The bet ran from 2008 to 2017. The results were not close. The S&P 500 index fund returned 7.56% annually. The hedge fund portfolio returned 2.08% annually. That's not a marginal difference. That's a 3.6x difference in returns. Buffett's simple index fund beat the professionally managed hedge fund portfolio by a factor of 3.6. Sides was not a bad investor. He was wrong about whether he could select hedge funds that would beat the market, but he was wrong in a way that's consistent with the SPIVA data. Most people can't do it. Buffett famously said in his 2016 letter to shareholders that he expects his estate's executors to invest his wife's inheritance in an S&P 500 index fund. This is not a modest bet. This is his life savings. This is not theoretical. This is how much he believes in index fund investing. An index fund is simple. It holds every stock in the index in the same proportion as the index. An S&P 500 index fund holds all 500 companies. If Apple is 7% of the S&P 500, then 7% of the index fund is Apple. No analysis, no guesswork, no manager deciding that Apple is overvalued and shouldn't be held. The advantage is that it eliminates stock picking risk. You're not betting on any one manager's ability to pick winners. You're betting on the entire market. You're betting that large American companies, as a group, will grow earnings and generate returns. Over 100+ year periods, this has been a winning bet. The other advantage is cost. Because there's no research team, no analysis, no trading based on new insights, index funds have minimal expenses. Vanguard's S&P 500 index fund has an expense ratio of 0.03%. That means if you have $100,000 invested, you pay $30 per year. An active fund charging 1% would cost $1,000 per year. The disadvantage of index funds is that you're not betting on superior manager skill. You're matching the market, which means you're beating 90% of managers, but you're not beating the market. But 90% of managers don't beat the market, so you're in good company. This is where the economics become stark. Let's compare a passive investor in an index fund versus an active investor in an average mutual fund over 30 years. Passive investor, $500 per month, 7% annual return, 0.03% fee. Total contributions, $180,000. Ending balance, $498,000. Active investor, $500 per month, 7% annual return, 1.0% fee. Total contributions, $180,000. Ending balance, $404,000. The difference is $94,000. The passive investor has $94,000 more simply because of lower fees. The active investor could have beaten the market, but 90% of the time, they don't. They underperform. The underperformance gets worse over time because fees compound. A 0.97% annual difference compounds to massive dollar differences over 30 years. The wealth gap in America is often attributed to income and luck, but fees matter. Investing in an active fund versus an index fund is a gap of thousands of dollars per year in opportunity cost. Over a lifetime, it's hundreds of thousands of dollars. For people starting with small amounts, that difference determines whether they reach millionaire status or not. The efficient market hypothesis states that asset prices fully reflect all available information. Strong form means all information, including private information. Weak form means all public information. The evidence supports the weak form. When a publicly traded company releases earnings, the stock price adjusts within seconds. Thousands of traders and algorithms see the information simultaneously. The price reflects the collective assessment of all of them. The challenge for active managers is that they have to find information that's not already priced in. They have to find a stock that the market is systematically mispricing. They have to do this repeatedly, consistently, and in a way that overcomes their fees. This is very hard. In fact, the SPIVA data says it's impossible 90% of the time. The prices you see are not random. They're not arbitrary. They're the result of millions of trades and analyses. To beat the market consistently, you have to be smarter than all of those analyses combined. It's theoretically possible, but empirically rare. There's an interesting psychological phenomenon in investing. The smarter and more experienced the investor, the more confident they are in their ability to beat the market. Overconfidence is a bias that increases with expertise. Doctors overestimate their diagnostic abilities. Lawyers overestimate their case outcomes. Fund managers overestimate their stock-picking ability. A study published in the Journal of Finance found that managers with the longest track records of outperformance were the most likely to underperform going forward. Why? Because they attributed past performance to skill when it was actually luck. The market is large and random enough that some people will beat it by chance. They attribute that to superior skill, get overconfident, and then regress to the mean. There's also the style factor. A growth-style mutual fund is bullish on growth stocks, so they overweight tech, high-growth companies. When the market rewards growth stocks, they outperform. When the market rewards value stocks, they underperform. They're not beating the market, they're making a market timing bet on which style will do better. Most of them make that bet wrong, most of the time. The inefficiencies that active managers try to exploit are disappearing, not growing. Information is more efficient. Algorithms trade faster. There's more data. It's harder, not easier, to find a misprice in the modern market, yet the number of active managers trying to do it hasn't decreased. They're all chasing a shrinking opportunity set. The result is that more of them underperform. Jack Bogle founded Vanguard in 1975. At the time, everyone in the financial industry said he was insane. He wanted to create an index fund that charged almost no fees, an index fund that was open to anyone. The industry argument was that investors would never buy an index fund. Investors want to beat the market. They want a manager who picks stocks. They want to feel like they have a shot at superior returns. Bogle believed that the data would eventually win. He believed that when investors understood that 90% of active managers underperform, they would choose the index fund. It took decades, but he was right. Vanguard grew to become the second largest asset manager in the world, based largely on low-cost index funds. Bogle's insight was simple. The winners in investing are not the smartest people picking the best stocks. The winners are the people who pay the lowest fees. Costs are the one variable in investing that you can control. You can't control market returns. You can't control which stocks will outperform, but you can control what you pay for investing.
This insight has changed trillions of dollars of assets from active to passive management. Index funds now control about 45% of equity assets in the US, up from less than 5% in 1995. This is not a niche strategy anymore. This is the mainstream. Here's how to implement this. First, choose an index fund. Vanguard, Fidelity, and Schwab all offer S&P 500 index funds with expense ratios under 0.05%. Pick any of them.
The difference between 0.03% and 0.05% is negligible. What matters is that you're not paying 1%. Second, automate your contributions. Every month, money goes directly into the index fund. You don't have to think about it. You don't have to decide whether now is a good time to invest. It just happens. Third, diversify beyond the S&P 500. A simple portfolio could be 60% S&P 500 index fund, 30% international index fund, and 10% bonds. Or 100% total stock market index fund if you're young and can handle volatility. The exact allocation matters less than the low fees. Fourth, rebalance once per year. If stocks go up and now they're 70% of your portfolio instead of 60%, sell some stocks and buy bonds. This forces you to buy low and sell high systematically, which is the opposite of what humans naturally do. Fifth, don't check the price daily. Markets move randomly day to day. Your wealth builds year by year. Daily checking creates noise that triggers emotional decisions. Annual review creates clarity and compounds your results. The numbers tell a different story about investing. You don't have to pick stocks. You don't have to find the manager with the best track record. You don't have to time the market. You just have to invest in an index fund with low fees and stay invested. That simple strategy beats 90% of professionals. That's not aspirational, that's the data. That's boring, but boring is profitable. That's the secret to wealth building that everyone overlooks because everyone's looking for an exciting secret.